persons under 35 and persons over 50 were the most confident. So the folks in the middle were a little less confident. So those are Gen Xers and probably the oldest millennials. But also by income, persons making more income tended to be much more optimistic.
You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Markus Schomer, Senior Economist with the Conference Board, and today's guest host. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the global economy. Joining me today is Dana Peterson, the Chief Economist and Leader of the Economy, Strategy and Finance Center at the Conference Board. Welcome, Dana.
Hi, Marcus. Great to be here.
What was the biggest takeaway from the June Consumer Confidence Survey?
Yes, well, overall confidence dipped a bit in June, but it really hasn't been deviating that much from the range that it's been in over the last 2 years, really. And so we're not really seeing a breakout either lower or higher in the measure.
Why do we see these patterns in consumer confidence?
Sure. So the confidence index overall is a combination of sub-indexes, and the two primary indexes are the current situation and also expectations. So the present situation measure continues to remain buoyant, and that's because consumers are overwhelmingly confident about their current job situation. Many of them are working, and also when it comes to business conditions, those were quite negative on net, but now they're improving. So that's really what's holding up the consumer confidence index, because the expectations gauge continues to weaken, and it's weakening, reflecting the fact that consumers are concerns about future business conditions as well as incomes, and also they're starting to be a little bit more concerned about the labor market outlook going forward.
Was there any differentiation by age or income?
Yeah, so persons under 35 and persons over 50 were the most confident. So the folks in the middle were a little less confident. So those are Gen Xers and probably the oldest millennials. But also by income, persons making more income tended to be much more optimistic.
Fascinating. So if we look at the two components, what drove the change in the present situations index?
Yes, well, the present situation index is comprised of two sub-indices. One is the current labor market, and the other is an assessment of current business conditions. Now, the labor market measure improved in the month, and indeed we asked consumers, do you believe jobs are easy or hard to get? So it's netting out that consumers are saying that right now it's pretty easy to find a job. However, the current business conditions measure cooled a bit, but again, it's the labor market that really overshadowed any weakness that we're seeing in perceptions about current business conditions.
So if the labor market perceptions are still quite positive, what influenced the expectations measure then?
Well, once again, the expectations measure ticked downward. In fact, it's been trending lower this year. And indeed, the thoughts about income in the future and business conditions weakened, and that weighed on the overall measure. Now, when it comes to future labor market conditions, they were a little bit less pessimistic, but still that measure is negative on net.
What is consumers saying more particularly about the recession?
Yeah, so consumers are giving us mixed signals here. When it comes to the expectations gauge, any measure below 80 often signals a recession. But as you notice, we haven't had a recession, even though that measure keeps dangling below 80. And I think what it's really signaling is expectations of a slowdown, because when we ask consumers point blank, do you believe a recession will happen over the next 12 to 18 months? Fewer are saying that they think that there is going to be a recession. So I think it's more about slowing economic conditions rather than a hard view that recession is coming.
Well, recession is one thing that consumers talk and think about a lot, but how about their views on the future of inflation? Can we gauge anything from the expectations index or from the write-in comments?
Yeah, so the write-in comments are great for getting a sense of what they think about inflation right now, and they continue to complain about the level of prices. That's the number one write-in, and so that's different from the rate of inflation. So the level is, well, bread is $10 or eggs are $8, and the inflation rate is how quickly those prices are rising. So in terms of expectations for inflation for the future, they continue to think that inflation, the rate of change in prices is going to slow. And so our expectations gauge dipped from 5.4% to 5.3%. However, they continue to complain about the prices right now, especially for food and groceries and energy. And so that's what we're hearing from the write-ins.
What do consumers think about interest rates in the stock market?
Well, the thing is that they think the stock market is going to continue to rally, and I don't blame them. They're probably hearing on the news all the good news, and so they see that as going to be continue to be positive. And typically that seeps into consumers' views about their own job prospects, and they think that if the stock market's soaring, their company's going to do well, they'll continue to remain employed. So that's good news. When it comes to interest rates, they have expected in recent months that interest rates might not fall as much, but we saw a bit of a reversal of that in this month, where they're now seeing that, or expecting that interest rates are going to dip. But we definitely do see the impact of elevated interest rates on their buying plans.
Now, how do consumers feel about their finances in general, which captures sort of both the employment and the inflation story?
Yeah, so we ask consumers about their family's financial situation, both currently and in the future. And both of those measures were a little less positive. They're still positive, but not as much so. And I think that's probably tied to the fact that they are becoming more concerned about business conditions going forward, their incomes, which is basically the flow of money coming in that affects the financial situation, and also job prospects. As I mentioned, again, job prospects are, the measure on net is negative, even though it's not as bad as it was in the past.
Given the fact that we're in an election year, was there anything interesting about sort of the political environment in the index responses?
Yeah, so we get an understanding of this from the write-ins. So from the write-ins in general, consumers are starting to say they're more concerned about the political situation on balance. But in terms of the election itself, they're not very much concerned about it just yet. And when we compared those write-ins now to 2016 and 2020, it's lower in relative to June in those years. But we think that it may pick up as we get closer to the U.S. election. So again, general concerns about the political situation, but no significant concerns about the election, at least right now in June.
What are consumers' buying plans regarding durable goods?
Yes, those buying plans have been waning over the course of the last 12 months. And they are not excited about purchasing big durable items like cars or homes or even appliances. And when we look at that on a 6-month smooth basis, because the measures are a little bit choppy, but the trend is unmistakable. And it's understandable because consumers, again, are complaining about high prices, and they are also concerned about interest rates. And interest rates, as we know, are at the highest we've seen in 30 or 40 years. And the Fed is being very cautious in terms of its timing of cutting interest rates. And so that's really eating into consumers' plans to buy any big ticket items that need to be financed.
And what about services?
Well, it's interesting with services. This month we asked about vacations, and consumers still want to go on vacation. And most of those vacations they're planning are in the US rather than abroad. And so there's still this vacation bug out there, some of that revenge spending on services. But when we look at the share that are saying they want to go on vacation, it's still below the pre-pandemic levels. And indeed, in prior surveys in recent months, we've asked consumers about what kinds of services they desire to purchase. They're trading down. They're buying services that are less expensive in terms of the discretionary items, and they're buying more of the necessary types of services like healthcare and also car insurance.
So tying it all together, what does the Consumer Confidence Index tell us about household spending this year?
Well, it's all telling us that consumers are probably going to continue to pull back on spending. And when they do spend, they're probably going to trade down, and they're going to spend on things that they absolutely need. This is consistent with our forecast for GDP growth this year. A big chunk of it comprised of what consumers are going to do. So we think certainly in the second quarter and the third quarter, GDP growth is probably going to be in the 1 to 0% annualized range. And we already saw negative spending, or negative growth rather, in durable goods in the first quarter, and it sounds like services are probably going to slow as well. But certainly as the Fed starts cutting interest rates, we think probably later on this year, maybe 2 cuts in the fourth quarter, and further cuts next year, that consumers will feel more emboldened to get out there and buy items that need to be financed, purchase homes, and all the items that go into homes.
Well, we're going to take a short break here and be right back with more of my conversation with Dana Peterson.
Mark your calendars for October 29th and 30th, 2024, because the Conference Board is hosting People 2030, Our Talent, Our Future, in Brooklyn, New York. This year's event promises to deliver actionable insights into the trends shaping our workforce and strategic decisions for a brighter future. Whether you're in HR, a company leader, or an industry enthusiast, this event is a must-attend. At People 2030, you'll learn how to put people at the heart of business value creation. We'll dive deep into creating purpose for your workforce, unleashing potential, and ensuring high productivity through technology, innovation, and engagement. And we've got a special treat for our podcast listeners. Use promo code CSP600 at registration and save $600. These 2 days are packed with opportunities to network with industry leaders and gain knowledge that will propel you and your organization forward. Don't miss out. Head over to tcb.org/people-conference to secure your spot. Remember, promo code CSP600 gives you $600 off. We can't wait to see you there.
Welcome back to C-Suite Perspectives. I'm your host, Markus Schomer, Senior Economist at the Conference Board. I'm joined by Dana Peterson, the Chief Economist and Leader of the Economy, Strategy and Finance Center at the Conference Board. Dana, we were just talking about the U.S. consumer confidence. What is the outlook for the U.S. economy more broadly?
Yeah, so as I mentioned before the break, we are expecting growth to be slower this year compared to last year. Why is that? Well, interest rates are extremely elevated because the Fed has been fighting back inflation for much of the last 2 years. And we've reached a peak in December, and interest rates aren't coming down for some time. We're looking at higher for longer rates, and that's certainly impacting what consumers are doing. It's also impacting the housing market. As we know, existing home sales have bottomed out, or rather, we're still looking for a bottom there. And new home sales have been pretty tepid. We saw a bit of a pickup earlier this year, but now they're coming back off again because prices are very elevated for homes. We saw the Case-Shiller Home Price Index come out at a new high, and also the National Association for Realtors Home Price Index today come out also very elevated. And between the affordability issues in terms of prices and interest rates, and also just poor consumer sentiment, we're not going to see much in terms of housing activity. So consumer spending weaker, housing activity probably weaker. So that leaves certainly the business sector. And we see that businesses are pulling back on investments in structures and equipment that's not technology. They are doubling down on intellectual property, technology, that sort of thing, automation. But when it comes to hard assets or even real estate, they've pulled back again because the cost of capital is quite elevated. So when we look at government spending, that's a bit of a wild card. Government spending since 2022, the middle of 2022, had been a very significant contributor to real GDP growth, and that's because of the infrastructure spending legislated by the government. We did see weakness in government spending in the first quarter, so we'll be curious to see if there's any more juice left for this year, or if we kind of maxed out in terms of the growth rates. And then there's also traded inventories, and those tend to be really big wild cards. And certainly we expect that imports will be weaker given the fact that consumers will be pulling back, but also external demand is pretty weak, affecting exports. So you're going to have a tug of war there. And inventories will really be about whether or not businesses have kind of mapped all this out correctly in terms of the supply-demand balance, and that'll impact inventories. But overall, slower growth this year, but faster growth next year. And again, as I mentioned, we're looking for 2 interest rate cuts at the November-December meetings, 25 basis points each, and then further cuts next year. But all in all, interest rates are probably going to land, policy rates are going to land at a level that's higher than what we saw pre-pandemic, probably in the 2.5% to 3.5% range. All right, well, Marcus, we're going to do something a little bit different today. I'm going to ask you questions about what's happening outside of the United States, giving you a recent update on the global economy. So let's get started. What is your outlook for the global economy this year?
Well, the outlook is for relatively stable growth if you just look at the aggregate numbers. Our forecast for the global economy overall is 3.1% real GDP growth this year after 3.2% last year, picking up again to 3.2% next year. So it's a relatively stable outlook after like a long period of pandemic-related volatility and all sorts of growth numbers all around the world. If we go a little bit beneath that, we'll see slightly diverging trends. The mature economies overall are impacted by weaker growth, as you already mentioned, in the US this year, but at the same time a rebound in Europe. So the stability in some of our forecasts masking some of the trends that are going on underneath. It's a similar story for emerging markets, where the overall growth numbers are also relatively stable, 4.4% last year, 4.3% this year. But underneath that, we see a strong rebound in Middle East and North Africa, for example. Oil producers had a very, very difficult 2023 and seeing a strong rebound this year. Asia is growing very strongly, but growth overall there is slowing, and Latin America is rebounding.
Thanks, Markus. And in particular, which economies will drive global GDP growth?
Well, it's mainly still Asia, if you look at the overall numbers, and that's a sort of a structural feature of the global economy that's been in place for a while. This year, more than 60% of the GDP growth that we're forecasting will come from Asia. And in fact, if you zoom in a little bit more, of course, the two really big economies, China and India, they will account for more than 50% of overall global GDP growth. So
wow.
Irrespective of some of the negative headlines you read about China, for example, more than half of the growth of the global economy still comes from China and India.
And that's why emerging markets are going to outperform advanced economies this year.
Yes, I mean, they typically outperform advanced economies. Behind that, of course, are sort of this idea of catch-up. Many of these economies are not as developed as advanced economies, and we're seeing strong growth in middle classes in these economies. It's not really about population growth anymore. That's slowing almost everywhere now, but it's the growth in the middle class, so people who buy their first car, their first house, their first set of appliances. That growth rate in emerging markets still much, much stronger than what we see in the advanced economies.
Yes, and you mentioned Europe. Europe seems to be making a remarkable recovery after a period of stagnation in the second half of 2023. Which economies are driving it, and why is this weird?
It is actually interesting. The overall numbers look better. Our forecast for European growth is improving this year, but it's not what you think. Typically, it's the core economies, Germany, France, the Netherlands, that are driving European economic growth, and from there it spills into the periphery. But this time it's the other way around. The periphery is showing all the good growth. Spain in particular is one of the star performers in Europe right now, but also smaller economies like Portugal and even Greece, who was in the news for so long as a problem economy for Europe. Even Greece is now showing strong economic growth. So it's interesting, it's the periphery, which does make it a little bit weird, and it's not the core.
Yes, very interesting. Well, let's talk a little bit about China. So the government in China is intent on achieving its quote-unquote around 5% target. But what are the looming risks to missing that target this year?
Well, we lacked a little bit of confidence in the government's ability to achieve that 5% growth target earlier this year, but we have revised our forecast up to now also forecasting 5% growth this year. And what's behind that is greater confidence that the stimulus measure the government has announced to offset some of the issues that the Chinese economy has, those stimulus measures look like they will be successful. It's a combination of monetary but mostly fiscal stimulus, and even tax cuts are being debated now in China that are designed to stimulate consumer spending and offset what's still running in the background, which is the slowly unraveling of the bursting of the housing bubble. That is still the biggest impediment for stronger growth in China, but the stimulus measures seem to be sufficient. That's why we think the economy will be able to achieve 5% growth this year.
Excellent. So I mean, there are different stories by economy, but in general, inflation globally is continuing to slow from kind of the peaks of 2022. Should we continue to expect this over the course of this year and possibly next year?
Probably. I think on balance, yes. I think we will still see slower inflation numbers in most parts of the world. But I think we're getting also now to the point, maybe in particular in the advanced economies, but also in several emerging economies, where sort of that last mile of getting inflation back to central bank target levels is proving to be more difficult maybe than a lot of forecasters and central banks had thought, which is one of the reasons why we've seen a slowdown in rate cut expectations. You already mentioned what we're expecting in the US, which looked a lot more bullish earlier in the year. But that's really something that happens everywhere around the world. Inflation is still trending lower, but slower than many people had expected earlier this year.
So given that these different rates of achieving or at least approaching target ranges, when do we expect certain central banks to cut interest rates? So some of them have already started cutting, especially in emerging markets. We've seen one or two in Europe, nothing in the US. And you mentioned there's been this slowing in expectation. So when are we going to start seeing a pickup in interest rate cuts?
Yeah, I think it's that was sort of the idea at the beginning of the year, that we would see this sort of spark that suddenly turns into a rate cut wildfire. But I don't think that's really what's going to happen. All the rate cuts that we're seeing so far have come with warnings that the future paths will be shallower. Future rate cut paths will be shallower, so the pace of rate cuts will be slower. You're right, we've seen rate cuts in Switzerland, in Sweden. The ECB cut rates once, but immediately dampened expectations of more rate cuts at the next couple of meetings. We've seen rate cuts in Canada, but it hasn't come into the US yet. I think the Fed is still very important as sort of the world leading central bank. But you already highlighted, we don't expect any rate cuts here until November and December. And then looking into 2025, you probably will see a larger number of central banks cutting rates, but the pace even next year I think will be slower than what we all expected earlier this year.
So given this, do we think that there will be any improvement in global growth next year? I know at the top you mentioned the forecast, and certainly when you look at the headline, I guess global is not very different. It's off by a tenth but each year. But looking at individual regions, do we think any regions will grow faster next year from interest rate cuts?
Yeah, I think interest rate cuts will be one of the drivers of stronger growth next year. And you mentioned already also emerging markets, which I didn't touch on. You can almost say half the emerging markets are cutting rates. Everybody in Latin America is cutting rates. It's starting to spread into Asia and Eastern Europe. Poland has cut rates. Czechia has cut rates. So in the emerging markets, we're seeing a broader push towards lower interest rates, which will help those markets. But I think the bigger story is that these annual growth rates that we often publish, they mask the dynamic in the quarterly numbers that are underneath. So in many instances, in 2024, the numbers are relatively stable at the beginning of the year, but start to pick up into the end and into 2025. So if you look at the dynamic of the evolution of our quarterly growth rates, they're already showing a pickup in the momentum in 2025, but it's not really captured in the annual numbers. So I think we will continue to highlight that sort of divergence. Growth is picking up next year, even if the annual number, it's not really showing it.
Well, thank you, Markus, for being here.
Thanks, Dana, for joining us today.
You've been listening to C-Suite Perspectives, a podcast by the Conference Board.